Don't you find it fascinating that every single crisis in the history of the United States was as a result of bank failures? I mean, just go back in history and you will realize that the reason behind any major crisis that has ever happened in the history of the United States, it was because there are some banks out there that failed. And right now, if you take a look at what's happening in the banking industry, we have almost 400 banks that are about to fail. I mean, just take a look at the history. The panic of 1957, guess what exactly has happened over there? Some banks out there failed and people felt threatened, so a lot of farmers during that time went to the bank to withdraw their money. And when some of them withdrew their money, it created panic in the market, and that forced other people to rush to the banks and withdraw their money, and that led to the catastrophic collapse of the entire banking system. And when a banking system fails, the entire economy fails. Now, go to the 1929 Great Depression. They call it the worst crisis in the history of the United States. Now, people point out to different reasons behind that crisis, but if you kind of just dig deep into it or listen to Milton Friedman, the former chairman of the Federal Reserve, it's clear that the main reason behind the collapse of the economy back in 1930s, it was a banking crisis. Now, even if you go to 2008 housing crash, yes, we call it a housing crash. But if you dig deep into the numbers and give it a more broader perspective, it was a banking crisis because the banks failed that gave up those mortgages to those people who couldn't actually afford it. And when those houses actually went down in value, the entire banking system collapsed. And when people some banks actually collapsed. And when people felt unconfident about their money in the bank, they rushed to the banks, and that was the end of the banking industry. And that's why if you go back to the 2008, you will find out that the government of the United States mostly bailed out the banks. Wells Fargo and a list of other banks out there. And that's why if you kind of want to understand if we have another crisis that's coming, then you have to pay attention at what's happening in the banking industry. Because the banking industry is the backbone of the economy. They manage how the money is actually being invested and managed throughout the entire economy. And when the most important tool or the most important commodity that we call the dollar, for example, if it's actually not managed properly in the economy, then we have everything collapsing. And that's mainly due to the fact that most of the economy is very highly leveraged, which means that most of the economy operates on a debt. And it's not just about the national debt, for example, of the United States that has been rising to $35 trillion, probably like already $36 trillion, but literally about everything. Take a look at the personal loans, take a look at the credit card loans, take a look at the auto loans, take a look at the mortgages. Like people, everything within the economy is leveraged. So what do you think happens to the institution that issues all of those loans? So if they collapse, that's the end of everything in the economy. So in order for us to understand the current crisis and understand how bad that crisis is, now some people might think that I'm exaggerating with the banking crisis that we have. But when I'm going to give you the numbers right in front of you, by the end of that video, you will be able to judge for yourself how bad that crisis is. Because that crisis is not happening right now, but it's looming in the background. And when it bursts, then it will be too late for you to do anything. So it's better for you to actually prepare yourself and understand what exactly is happening and get yourself ready. Now, to understand that, we need to have a brief, short understanding of how the banking industry overall works. Because without having that foundation, what I'm going to explain to you about the banking crisis won't really make much sense. So a bank is basically the middleman that manages the money within the economy. It basically takes depositors' money, people like you, people like me, who take their cash, who take their savings, and we go to the bank and we basically deposit it in the bank. Then the bank is going to take that money from us and will either lend it to someone else in form of different kind of debts. For example, mortgages, auto loans, personal loans, credit card loans, and of course, it's going to lend it at a much higher interest rate than the interest rate it's actually offering to you. If it's offering you 3%, then it will loan it. If it's a credit card debt, then it's a 25% interest rate. If it's a mortgage, which is a long-term debt, it's significantly lower than that, but still it's like 6, 7, or maybe in some cases 8%, if not higher than that. But that's not the only way for the bank to manage your money. The second thing that the banks do with your money, they invest it in some kind of a safe place, because there is not always an opportunity for the banks to loan that money to somewhere. There are not always people who want to take an auto loan. Yes, we have plenty of them, but not enough for all the banks in the country. And that's why they take that money and they start investing it, and mainly in US government bonds. Why? Because US government bonds are the safest investments out there, and you can't risk your depositors' money investing it in the stock market. You have to invest it somewhere so they generate some interest. Because at the end of the day, when you have to pay some interest to your depositors, you can't just keep your money and keep it in the bank and just keep paying interest to your depositors when you are not making money at all. And that's something we know because of something that we call fractional reserve banking. If you have your money deposited in the bank, not all of your money in the bank, just a fraction of it in the bank, and most of that money is invested by the bank, which is absolutely normal. There is absolutely nothing wrong with that. Of course, if everybody at the same time will come to the bank to withdraw their money, the bank is going to be in crisis. But because most of your money is invested in different kind of assets, because it's either not just invested, but it's actually lent to other kind of entities, it's extremely important for the bank to have a very healthy balance sheet. A balance sheet is basically a financial statement that is issued by any company, including the banks, in order to show to the investors about the financial situation of the company. It's basically a snapshot of the financial position of the company. So on one side we have assets, on the other side we have liabilities and equity. And to understand what is balance sheet, the formula for it is very simple. Assets equals liabilities and equity. Assets are anything that the company owns. Liability is everything that the company owes. And because any business that is being started by somebody, so some money is put into the bank in the first place, that is what basically the capital that the investor or the founder of the company throws into the economy, or the money that's being later on raised by the investors. And that's what we call equity. Your assets should always equal your liabilities and equity. And if there is any kind of mismatch, then you are going to have a trouble with the business. Now, when it comes to any kind of other traditional business out there, what I'm going to say right now is not really extremely important. But when it comes to a bank, banks work slightly differently, because banks don't really innovate something different. They don't have any kind of traditional products. What they do is that they basically manage money. They take money from depositors and then they invest it somewhere. They throw it in, they lend it to someone else. And that's why if you take a look at the balance sheet of any bank, for example, on the side of the balance sheet, you always have like a lot of cash. You have investments that the business actually made, for example, in government bonds or any other kind of assets. On the side of liabilities, you have, of course, depositors. And depositors' money is, of course, a liability. If you're lending money to a bank, to you, it's an asset. But to a bank that you lend your money, it's a liability, because that bank has to pay you back. So on the other side, we have either depositors or we have maybe other kind of liabilities that a bank has. So if we take all the assets that the bank has, for example, which equals, let's say in this case, $67 billion, the liabilities of the bank plus equity are also $67 billion. And these numbers should always match. Now, if for some hypothetical reason, just as an example, that our assets are going to go down for some reason, let's say the value of our assets are going to go down, what do you think is going to happen? Because our assets went down, our liabilities stayed at $67 billion, but our assets right now worth, let's say, $60 billion. Suddenly, this bank does not have enough assets in order to pay its depositors. And people who look at this kind of a balance sheet in a bank, they will get afraid and they will go instantly to withdraw their money from that bank. And that will cause in the market something we call a panic. And that panic can spread within or throughout the entire economy and lead the entire banking industry to collapse. This is exactly what has happened in every single other major crisis that the United States ever had, or any other country, in fact. And it's very clear if you actually go and read the history. And now let's take a look at the banking situation right now in the country and see if we have such a problem, if there is such a problem looming in the background. I'm not gonna just come up with it. I'm just going to show you the numbers. I'm going to just show you the facts, and you decide for yourself whether we have such a crisis that actually can cause a real banking crisis that already caused in 2008, in 1929 with Great Depression, and with every other crisis out there. The major investments that the banks usually make when it comes is government bonds. They don't invest in anything else other than government bonds because they have to make sure that the money they have actually invested that they have actually taken from their depositors, they have invested them in somewhere that is extremely safe. And this is the problem. Now, how is that even possible? Because government bonds are the safest investments out there. On the other side, because they have invested so much in government bonds, it is creating a very, very serious problem and pressure on the banks that is about to lead most of these banks to collapse. And it's not just my words. If you just go to the chairman of the Fed, he was invited to Congress to for some questions out there. The video is right there out there. And he clearly said that a lot of banks are on the brink of bankruptcy. And this is not my words. It's a very well-known fact in the economy, and for some reason people don't really talk about it. Now, in order to understand that, we need to have a very brief understanding of how government bonds work. Now, a government bond is a very simple security which is a loan to the government. So if the US government wants to borrow money, what it does is that it will create a piece of paper or a document that says that whoever owns this piece of document, the government owes him that much money plus X amount of interest. And that's why if you take a look at the US national debt, it's constantly rising, and that's because the US government bond constantly issuing those debts. Now, the interest rate that is set on those government bonds is usually, or not usually, pretty much always is a reflection of the interest rate that is set by the Federal Reserve, because it borrows most of its money from the Federal Reserve. So the interest rate, for example, are 1%, and government bonds will have around 1%, 1.5%, maybe at best case scenario 2% interest rate. Well, if the Federal Reserve suddenly increases interest rates, let's say to 5%, now, the new government bonds will have at least a 5% interest rate, maybe even 5.5%, maybe 6%. And now, when you understand this simple idea, you understand the real problem that is happening. Now, government bonds, just like stocks, are being traded in the market because, for instance, we have a government bonds that expires in 10 years, and it was issued, for example, last year. Now, it's in the market for another 9 years. And its value can fluctuate based on the situation that I will explain right now. Imagine, for example, in 2020, the government issued a government bond that is a 10-year bond that has an average interest rate of 0.6%. Now, why the interest rate is so low? Because if you go back to 2020, the Fed lowered the rates to almost 0%. So the government bonds had a 0.6% interest rate, which is slightly higher than the Fed, because the Fed's rate was 0 to 0.25%. Now, if you have purchased $1,000 government bonds that expires in 10 years, it is going to pay you $6 annually, because 0.6% on $1,000 is $6. And a lot of banks during 2020, because there was such an inflow of money into the economy, the government was kind of printing trillions of dollars and throwing into the economy. People received their stimulus checks, thousands of dollars, and people deposited that money in the bank. Now that bank, or any other bank in the country, took that money. Guess what they did with all of that money? They purchased a lot of government bonds because they couldn't lend it. They couldn't lend so much money to other people. They had to do something with that money. So the bank purchased a lot of government bonds. That was 2020 and 2021. Now, fast forward to 2020 and 2022 and 2023 and later onwards, what happened is that the Federal Reserve suddenly raises interest rates to over 5%. Now, in 2023, for example, when the government issued new government bonds that are 10-year-old, that will expire in 10 years, they will have at least an interest rate of 5%. Why? Because who would actually buy government bonds when the interest rates are at least 5%? The government, if you take a look at the national debt of the United States, it's constantly rising. Why? Because the government constantly raising money. It's constantly creating debt. It's constantly issuing those government bonds. And if you want people to buy those government bonds, then you have to at least offer a competitive rate that is actually based on the Federal Reserve. And that's how the Fed actually controls the economy and controls, even to some degree, government spending. Now, the new government bonds that are issued after 2022 has an interest rate of at least 5%. And even if you go to the chart that I have right in front of me, you can clearly see that. For instance, in September 2020, government bonds were like around 0.5%. Now, by 2023, those 10-year government bonds had an interest rate of almost 5%. So that is exactly what has happened. Now, I want to ask you a very simple question. Which of these government bonds are you more likely to purchase? If you have $1,000 in your pocket right now, will you buy a government bond that will offer you a 5% interest rate that is going to be $50 annually, or you're going to go and buy a government bond that offers 0.6% interest rate, which is $6 annually? Like, which one of them are you going to purchase? Of course, no one is going to purchase these government bonds that have an interest rate of 0.6%, and everybody is going to purchase the government bonds that have a significantly higher interest rate, which is 5%. And that creates a fundamental problem, because remember, bonds in the market right now are being traded just like stocks. And when the interest rates have risen and there is a much more higher demand for the government bonds that have been issued later because they have a higher interest rate, what do you think happened to the demand for the older government bonds that all these banks purchased in 2020 and 2021 that have an interest rate of 0.6%, like an interest rate of less than 1%? Nobody wants them. So on paper, the value of those government bonds went significantly down because nobody actually wants them. And that's why if you take a look at the balance sheet of those banks, you will realize that the value of those assets in the market are much lower than the money that they owe to their investors. Now, a lot of people might say that, well, it's not really a big deal because their value is only down on paper, but in reality, they will still recover that money from the government and they will be able to pay off their investors. And that's absolutely true. But that's just part of the problem, because the second part of the problem makes the situation significantly worse than it's already. Now, guess what happens? Now, it's 2022 or 2023 or even 2024. Interest rates are above 5%, and now banks have to attract capital. They want the regional banks, they want you to go take your money and deposit it in their bank so that you can receive interest on the money that you have. Now, they cannot do that when they will offer you a 0% interest rate. They cannot do that when they offer you a 1% interest rate, when the Federal Reserve offers you a 5% interest rate, so you can basically buy government bonds. What is the point of keeping your money in a bank? Because interest rates are at least 5%. Now, all those banks have to offer you a higher interest rate in order to stay competitive. So they're offering you a 5% interest rate to keep your money in that bank, but all the money that they're making from older bonds that they have purchased in 2020 and 2021 is getting them 0.6% interest rate. So they're bleeding cash every single day. And that creates a fundamental real problem, because now they have to offer you a much higher interest rate than the amount of money they are getting from the investments that they made the last 2 to 3 years. Do you see the problem? So they're bleeding cash. Now, there is a way to fix this problem. And the way to fix that problem is to take a portion of those bonds that they have purchased and sell them in the open market, raise capital, and restructure their business, and they can still survive, and most people won't have any kind of problem. And in the long run, the bank can simply accumulate more profit, and instead of kind of giving it up in form of dividends or their shareholders taking that money out, they can just redistribute it and just turn the bank into a healthy state, right? But that's not how people think. That's not how most people. When your bank suddenly starts selling government bonds in the open market and their value is less than the value of the money that you owe to your depositors, what message does that send to the people? That this bank literally, based on its balance sheet, cannot possibly repay its depositors. That creates panic. People rush to the bank and they withdraw their money. One person withdraws, second person, and then that will actually create a flood of people withdrawing their money from that bank. And suddenly that bank will find itself in a crisis because it does not even have the money to give them out. What that creates? A bank failure. Now, you might think that this is a very hypothetical scenario. This is not going to happen. That this is just, you just coming out with a hypothetical scenario. But guess what? This is exactly what happened with Silicon Valley Bank. 40 to 50% of Silicon Valley Bank's investments were in government bonds that it purchased in 2020 and 2021. And because it had to sell a portion of their government bonds in order to kind of adapt, it created a panic, and that bank went into a failure. And it was just the first bank that went to a failure, because the second bank was the First Republic Bank. And then we had a short list of banks that actually failed. Now, thankfully, the government stepped in on time and ensured to everybody that, guys, please don't panic. Everything is perfect. Don't worry about it. We are going to give you every single penny that you had in that bank. Don't worry about it. The government is here to ensure that everybody gets his money back. And the reason that the government did that is because the government was afraid that if the government is not, if the government is not going to do that, it will create a panic in the market, and this literally just destroy the entire banking system. And again, when the banking industry is destroyed, it takes down with it the rest of the economy. And that is why it is already happening. Yes, with SVB and the First Republic Bank, it wasn't that bad because the government stepped in. But we have like almost 400 banks in such a situation that are about to get wiped out. Now, is there a way to solve this problem? Well, absolutely. The way we can actually solve this crisis is very simple, is for the government to step in and lower down interest rates. When they lower down interest rates, those government bonds that those banks purchased in 2020 and 2021, their valuation will increase, and that's how they balance their balance sheets. But if you actually watched my previous video about the state of the US economy, you clearly understand that the Fed is not in a position to lower down interest rates in the foreseeable future below 3%. It might happen, but not in the next few years. So theoretically, not even theoretically, I would say practically, those banks will have the pressure of those government bonds in the years to come. And God knows how long these banks can actually take that pressure. It might be 6 months, it might be a year, it might be 2 years. And the problem is that it doesn't happen like gradually one bank after another. When there is one bank failure, it instantly creates like a domino effect, and the banks instantly, all of them start going down because confidence in the banking industry just disappears overnight. And this is the fundamental problem that most banks in the country are facing. And guess what? This is the first problem. The second problem these banks are actually facing is the lending that they have made to commercial real estate. Now, on the other side, one of the largest lendings that the banks do is that they lend money to purchase commercial real estate. And they work slightly different than traditional mortgages where you actually take money to buy your house, because those rates are adjustable, which means that if the interest rates are being raised in the country by the Federal Reserve, then the interest rates on their commercial loans are going to get actually risen as well. So what happened since 2020 is that work from home became more popular and the demand for commercial real estate started going down, which means that in order for the people who actually took the loans, purchased this commercial real estate, and now lending them to offices, to businesses, to different kind of enterprises, now they have to lower down their interest rates in order to get somebody to rent that place in the first place. The demand is very low. What do you think happens? Now, because they're lowering down their rents, which means that not all of them will be able to pay to the bank. Second problem is that because the rates are adjustable, the bank has increased the interest rates on the commercial real estate, which means that the payments that now these people who borrow so much money for the commercial real estate, they have to make higher interest rate. So they lower down their rent prices. On the other hand, now they have to make a larger payments on their loans in order to keep those real estates. And that's why if most of these borrowers right now are defaulting on their loans, not most of them, but a pretty good percentage of them. And the more of them are going to default, the more pressure it is going to lead or put on those banks, which means that it's going to further worsen their balance sheets and will actually increase in confidence in all of those banks. And that is the fundamental problem that most of the banks right now are actually facing. I don't know when this bubble is going to burst, but if you kind of dig into the number, take the balance sheets of all of those banks, you will see some banks have as their investments like 30, 40, or probably even 50% of their money has been invested in government bonds that they purchased in 2020 and 2021 that have a very low interest rate. Best way that I know that you can protect yourself and protect and grow your wealth is to start investing and put your money to work. Now, achieving mastery is really difficult. It takes years, if not decades. And that's why most people never start investing. And even if they do, they never learn how to do it effectively. But if you want to learn how to start investing and get real results in a month or two and learn how to make your first $100,000 in the stock market, then check out the first link in the description. Thanks guys for watching, and I will see you in the next one.